There is a distinction that almost no financial commentary makes clearly. The distinction between what the wealthy say they are doing with their money, in interviews, in conference panels, in the kind of public-facing commentary that gets covered by financial media, and what they are actually doing. What they say, the economy is resilient, AI is transformative, long-term investors should stay the course. Equities remain the best vehicle for wealth accumulation over time. What they are doing, moving 54% of their portfolios into alternatives, accumulating private credit at the fastest pace in a decade, sitting on record cash positions, buying gold at levels not seen since the aftermath of World War II, building liquidity buffers that their stated investment philosophy would not require. These two things are not the same. And the gap between what the wealthy say and what the wealthy do, measured in actual capital flows, in actual allocation shifts, in actual portfolio construction decisions made by the most sophisticated investment minds in the world, is the most important signal in finance today. This is Capital Briefing. If you are here for the first time, subscribe now before we continue. Turn on notifications. What we build on this channel is the translation of what institutional capital is doing before the public narrative catches up. The gap between when structural shifts begin and when they become headlines is exactly where the most consequential positioning decisions get made. Subscribe now. Then let me show you exactly what the data reveals. Let me start with the most important structural shift in wealth management that is almost never discussed in mainstream financial media. Family offices, the private investment structures that manage the wealth of the world's richest families, operating with complete investment flexibility and no requirement to generate returns that satisfy external stakeholders, have undergone a fundamental portfolio reconstruction in the last 3 years. The data is unambiguous. Alternatives now constitute 54% of U.S. family office portfolios, not as a rounding error, not as a small allocation to hedge risk. More than half of all capital managed by the most sophisticated private wealth structures in the world is in asset classes outside of public equities and public bonds. Private credit, loans made directly by private lenders to businesses, bypassing the traditional banking system entirely, has emerged as the fastest-growing allocation category. Nearly 1 in 3 family offices is actively increasing its private credit exposure in 2025 and 2026. The asset class delivers what one analysis described as higher returns paired with risk management in today's market environment. The emphasis on risk management alongside return is the signal. In a normal market environment, the conversation is primarily about returns. When sophisticated investors begin leading with risk management, the environment has changed. The capital architecture that the most sophisticated family offices are using in 2026 is described by wealth advisors as a fundamental departure from traditional asset allocation. Modern family offices now think in terms of what analysts describe as capital architecture, not asset allocation. Capital segmented not by asset class, but by function. Capital preservation designed to protect purchasing power rather than maximize returns. Cash flow engines that generate predictable contractual yield, strategic optionality for asymmetric upside, and control capital where governance rights matter more than mark-to-market valuation. This architecture has one unifying characteristic. It is built for a world where the standard assumptions of the 2010s no longer hold, where inflation is not dormant, where geopolitical stability cannot be assumed, where central banks cannot cut rates to zero without creating problems they cannot solve. The families that built this architecture in 2021 and 2022, before the inflation surge fully materialized, before rate rises changed the calculus for every public market, are the ones that advisors are now pointing to as families that move quietly and win. That phrase is worth holding. Move quietly and win. Not loudly, not in headlines, quietly. Subscribe to Capital Briefing if this framing is giving you the structural context you have been looking for. Turn on notifications. The next video on this channel examines the specific mechanics of private credit as an asset class, what it is, how it works, why family offices are moving toward it, and what the structural risks look like that mainstream commentary ignores. Subscribe now. Then let me show you the gold signal, because nothing communicates the depth of this repositioning more clearly than what central banks have been doing with gold for the last 4 years. Central banks, the most conservative institutional capital managers on earth, bought more than 1,000 tons of gold in 2022. 1,082 tons to be precise. That was the highest level of annual central bank gold purchases since 1950. It was not a one-year event. In 2023, central banks bought 1,037 tons. In 2024, 1,045 tons. In 2025, 863 tons, below the extraordinary pace of the prior 3 years, but still well above the long-run historical average. In January 2026, gold passed $5,500 per ounce for the first time in history. Since 2020, gold has risen more than 230%. In 2025, global gold demand exceeded 5,000 tons for the first time in recorded history. These numbers require interpretation, because at face value they look like a bull market. They are more than a bull market. Central banks do not buy gold for return. They buy gold for what it represents in their reserve structure, an asset with no counterparty risk, no liability attached, no dependency on another government's fiscal decisions or monetary choices. Central banks buy gold when they believe that the other things they hold in their reserves, primarily US dollar-denominated assets, primarily US Treasury securities, carry structural risks that they did not previously carry. The question that flows from the data is therefore not, why is gold going up? The question is, what risk are central banks hedging against by accumulating gold at historically unprecedented rates for 4 consecutive years? The answer is documented in the acquisition patterns themselves. Poland added more than 100 tons to its gold reserves in 2025 for the 2nd consecutive year. The governor of the National Bank of Poland has stated publicly his intention to increase reserves further to 700 tons for, in his words, national security reasons. The Czech National Bank added 20 tons. Kazakhstan added 57 tons. China continued accumulating. Turkey continued accumulating. The country's leading gold purchases are disproportionately concentrated in regions with direct exposure to geopolitical fragmentation: Eastern Europe, Central Asia, emerging markets with significant US dollar trade exposure, and heightened concern about financial sanctions as a geopolitical tool. The signal is not subtle. Institutions with the longest investment horizons and the most acute geopolitical awareness on Earth are systematically reducing their dependency on US dollar-denominated assets and increasing their exposure to the one asset class that cannot be debased by government action and cannot be frozen by financial sanctions. This is not investment advice for individual portfolios. It is a documented description of what the most sophisticated institutional capital managers in the world are doing, and what their behavior implies about how they view the current structural environment. Now let me take you inside the psychology of what is actually happening in wealth management right now, because the numbers alone do not capture the full picture. The wealthy are not simply changing what they buy, they are changing what they are trying to achieve. For most of the period between 2010 and 2021, the era of quantitative easing, zero interest rates, contained inflation, and relative geopolitical stability, the primary investment problem was finding the highest return. Cash was trash. Bonds offered near zero real yields. The answer was equities, and within equities, US large-cap technology stocks provided a decade of performance that made everything else look like a mistake. That problem has been replaced. The new primary investment problem is preservation. Specifically, preserving purchasing power in an environment where the purchasing power of fiat currencies is structurally under pressure, where the standard correlation between stocks and bonds, which provided the foundational diversification argument for a 60-40 portfolio for 60 years, has broken down in an inflationary environment, and where geopolitical fragmentation creates supply chain vulnerabilities and energy risks that translate directly into inflation that central banks cannot control without creating other problems. The J.P. Morgan 2026 Global Family Office Report captures this shift directly. Among family offices that ranked inflation as their top concern, the allocation to alternative assets was 60%, 22 percentage points higher than average. They were holding twice the real estate exposure and significantly higher hedge fund allocations compared to families that did not rank inflation as the primary risk. Geopolitical risk and recession worries dominated the stated concerns of family office respondents across every major survey conducted in 2025 and early 2026. Not AI, not growth opportunities, risk and preservation. This is the psychology shift that the public has not fully absorbed. The dominant narrative in retail financial media remains oriented toward growth, toward finding the next high-performing equity sector, toward riding the AI productivity wave, toward the optimism that characterized the post-2008 recovery era. The people running the largest private wealth structures in the world have moved on from that narrative, not because they are pessimistic, because they are rational and the environment has changed. Let me now explain the third major element of this repositioning, the one that is most directly relevant to understanding the structural nature of the shift. Deglobalization is not a trend. It is a structural reversal. The global economic architecture that characterized the 3 decades between 1990 and 2020 was built on a set of assumptions. That global supply chains could be optimized purely for efficiency without regard to geopolitical risk, that manufacturing could be concentrated in low-cost regions regardless of the strategic implications, that energy could be sourced from the globally cheapest producers without regard to the political dependencies this created, that the rules-based international order would hold. Each of these assumptions has been challenged, not gradually, but through concrete shocks. The 2021 to 2022 supply chain crisis revealed that efficiency-optimized global supply chains had no redundancy when disrupted. The Russian invasion of Ukraine and the subsequent gas crisis revealed that European energy dependency on Russian supply was a structural vulnerability. The US-China trade tension and the semiconductor restrictions revealed that the division between national security and economic efficiency was not as clean as 3 decades of globalization had suggested. The sanctions against Russia revealed that the US dollar's role as the global reserve currency could be deployed as a geopolitical weapon, prompting every sovereign wealth fund and central bank with significant dollar exposure to ask whether their reserve allocation was appropriately risk-managed. Wealthy families are building portfolios for this fragmented world, not the integrated world of 2015. That means increased exposure to domestic and near-shore productive assets. It means energy infrastructure, not just energy equities. It means supply chain resilience, not just supply chain efficiency. It means gold, which cannot be sanctioned. The specific investment expressions of this posture vary by family office, by geography, by risk tolerance. The underlying logic is consistent. The world is reorganizing around geopolitical blocks, and portfolios built for a globally integrated world need structural adjustment. This adjustment is happening. The public has not yet internalized what it means for asset pricing across every major category. Let me now address the most important psychological dynamic in this entire picture, the one that explains why most people are watching this repositioning happen without acting on it. The 2010s are over. The conditions that made that decade an extraordinary period for public equity investors, zero interest rates, low inflation, stable geopolitics, China-driven global growth, quantitative easing that inflated every asset price, are not returning. But the mental model of most retail investors was formed in that decade. The intuitions about what a normal investment environment looks like, about what a normal rate of return looks like, about what a normal risk-reward trade-off looks like, all of these were calibrated to an anomalous period. The wealthy families that are repositioning right now are not expecting a collapse. They are not building bunkers or liquidating everything. They are making a cooler-headed, data-driven assessment. The environment has changed, and the portfolio that was appropriate for the old environment is not the portfolio that is appropriate for the new one. One advisor quoted in coverage of this repositioning said it precisely: "The velocity of capital deployment will become a significant competitive advantage, especially in dislocated markets. Families that have the capacity and process to move quietly and win. Move quietly, not loudly, not in headlines, not when the CNBC Chiron announces the crisis, before the Chiron. In the period that the data describes as ongoing repositioning rather than crisis response, that period is now. The shift from maximum growth positioning to resilience-first positioning is not a reaction to a crisis. It is a preparation for a structural environment that the data, across capital flows, gold markets, family office surveys, private credit growth, consistently describes as fundamentally different from what preceded it. The public is still waiting for the signal. The signal is in the data that has been accumulating for 3 years. Let me close with what I believe is the most important practical observation from everything I have described. There are 2 investment postures available right now. The first posture is the continuation of the 2010s playbook: heavy public equity allocation, U.S. large-cap concentration, minimal alternatives, minimal inflation hedging, minimal liquidity buffer. This posture maximizes return in an environment of low inflation, low rates, and global stability. It performed extraordinarily well for 12 years. The second posture is what the data describes the most sophisticated capital managers building: diversification into alternatives, private credit, real assets, gold, domestic productive capital, liquidity buffers. This posture sacrifices some upside in a continuation of the 2010s environment. It provides significantly more resilience in the environment that the structural data suggests is more probable for the next decade. The question is not which posture is definitively right. The question is which posture reflects the current structural reality more accurately, and which posture the people with the most information, the most analytical resources, and the most direct access to global capital flows are choosing. The answer is in the data. Family offices, 54% alternatives. Central banks, 4 years of gold accumulation at historically unprecedented rates. Money market funds, $7.75 trillion and counting. Berkshire Hathaway, $397 billion in cash and short-term treasuries. These are not isolated data points. They are a consistent directional signal from the most sophisticated capital managers on Earth, all pointing toward the same fundamental conclusion. The economy they are preparing for is different from the one the public expects. The shift has started. The question is not whether you see it, the question is when you act on it. Subscribe to Capital Briefing now. If this video changed the way you read the data on institutional capital repositioning, turn on notifications, leave one comment, one honest answer. When you look at your current portfolio, what percentage is positioned for the economy that existed between 2010 and 2021? And what percentage is positioned for the economy that the structural data suggests is emerging? Because the wealthy families building portfolios for a different economy are not waiting for consensus. They are already there.